Hello and welcome to the Business Standard Morning Show. I'm Veenu Santhu. Let's take a look at the stories for the day. Finance Minister Nirmala Sitharaman announced a string of changes in taxation in this year's budget. These are set to come into effect from tomorrow. Not only has the default tax regime been changed, taxation of mutual funds and market-linked debentures have also been altered. So, should you make any changes to your financial planning? Tushar Verma brings you the answer.
The world we look at today won't be the same tomorrow, especially when it comes to your personal finance. Come tomorrow, the new rules of taxation and changes announced in the budget this year will come into force. The impact is going to stretch from your income tax and life insurance to leave encashment. We reached out to experts to understand the changes in the tax structure, which can help you adopt strategies to maximize portfolio growth.
I would say the most important change is that now the new income tax regime will be the default regime. What this means is that if you are salary, then perhaps your employer will most likely deduct TDS based on the default regime, unless you give a sort of a confirmation that you want to opt for the old tax regime. I think this is one of the most important things that taxpayers need to be careful of. The other, of course, is the new change around taxation of debt mutual funds.
The new income tax regime is going to be the default regime from FY24. However, you can continue to stick to the old tax regime. The new regime makes tax rebate limit to 7 lakh rupees. That means taxpayers under the new regime will pay tax on their incremental income above the 7 lakh rupees threshold. The idea is to incentivize the new tax regime, particularly for small taxpayers. But how should you choose the regime and what are the things you should gear up for?
Unless you have a home loan or you are staying on rent and claiming HRA also, it's likely that the new tax regime will be a better choice for you as an investor. Now, with that, new tax regime does not allow deductions for any tax saving investments. So clearly, that area of tax planning will recede to the background if people start opting for the new tax regime.
If you're someone who's in a high tax bracket, say upwards of maybe 3 to 5 crores, upwards of that, then definitely you benefit from being in the new tax regime because the tax rates are lower. If you're somebody who's in the vicinity of say 7.5 lakhs, then again, new tax regime for you because up to 7.5 lakhs, you will not pay any tax because of the new tax rates and also because of standard deduction being introduced in the new tax regime.
Another key change is the taxation of debt mutual funds and market-linked debentures. Investments in these instruments were taxed as long-term capital gains if held for more than 3 years. From tomorrow, these will be taxed as short-term capital gains according to the taxpayer's income level. It will strip investors of the indexation benefits which made these instruments popular. So, how should investors go about it?
I think this was long overdue. Government was aware of the fact and government was seized of the fact that people were taking advantage of that lacuna or loophole, if I may call it as. A lot of HNIs were using that route earlier and they were parking their money, in those debt mutual funds. They were getting two benefits predominantly. One is lowering the tax rate from 30 to 20%. And second benefit is, which was again a significant benefit, they would get benefit of inflation adjustment. Now, most of the debt mutual fund schemes are gone now, and I would say there is no tax arbitrage left. So in terms of realignment of your portfolio, one is there is still very limited window of 2 days. If you want to lock in your debt mutual funds, lock in right now. And because this kicks in from April 1st and all the past investment that you've done will continue to have the same treatment, so they are grandfathered.
Life insurance is also an essential part of the portfolio. The key change you are going to see here is the taxation on life insurance policy. The exemption limit from proceeds of premium payment has been reduced. From 1st April, only the proceeds from the annual premium payment of Rs 5 lakh will be exempted. If the premium exceeds Rs 5 lakh, it will be taxed. But why has this change been done, and what impact will it have?
So I believe government must have introduced in after having a good thought through process, because for the years and years the government has been motivating people to do life insurance, and now all of a sudden they are saying that any proceed from the insurance would be taxable above 5 lakhs. So obviously it is a deterrent. This may be the reason from now on the government might have done for a reason that going forward, even by introduction of a new income tax regime, government would like to discourage telling people that where they should invest. Rather, they want to give a blanket tax exemption by increasing the tax slabs.
As the new financial year begins, one should watch out for the tax slab he or she falls into, especially since the new regime is the default. Moreover, it is apparent that the government is incentivizing the new tax regime. With debt mutual funds de-incentivized, alternate investment funds may gain prominence.
Even as India's global clout grows, market experts point out that while several Indian firms have a formidable presence in international markets, there seems to be a lack of truly global brands originating in India. Now, is this true? And if so, what will it take for India to create a global brand? Debargyo Sanyal looks at the big picture.
India seems to have captured the world's fancy lately, be it the G20 presidency or the rising number of Indian origin leaders in global business and politics. India is making rapid strides in the global arena. The country is also turning out to be a major tech and manufacturing hub and a name to reckon with in global cinema and music awards. Even as its global clout grows, experts point at the dearth of global brands from India. There are many Indian companies known across the world, at least in business circles, including Tata, Reliance, and Vedanta, among others. In the tech sector itself, companies like TCS, Infosys, Wipro, and HCL are well-known names globally. However, writing for Business Standard, Shekhar Gupta points out that none of these companies have created a brand that rules the world. So how can India create a global brand?
First and foremost, we have to look at universal relevance. The second is that we really need to up the game as far as quality is concerned. One thing, of course, which is also required, if you have ambitions to take your brand globally and make it a global brand, is scale. So you have to think in terms of scale, both in manufacturing as well as distribution. Then I think, and now specific to India, if India needs to create strong global brands, then there has to be something which is uniquely Indian.
On the other hand, some experts also say that India itself is a major brand now.
So nation branding as a task, if you look at, it all starts with a nation and the kind of governments that actually lead the nation. It starts with the kind of leaders who lead the nation. So on that perspective, I think we have it very good. We have Mr. Narendra Modi leading India with a brand image which is dominant and solid. We have a governance structure which is considered very dominant and solid. We have an economy which is a subset of that, which actually is booming at this given point of time.
Meanwhile, writing for Business Standard, Naushad Forbes, co-chairman of Forbes Marshall, also pointed at brands like Apple, Hyundai, Samsung, and others who have made their journey from being original equipment manufacturers or OEMs to owning, designing, and manufacturing, and finally becoming their own brand manufacturers or OBMs.
Well, I think Air India was a global brand. You were certainly, I think, considered amongst the world's top 10 airlines. Airlines is a great possibility because we're going to be a huge aviation market. Even brands like Indigo, etc. Why they can't become global? And they can give it its unique sort of an Indian spin. Food is a huge opportunity because Indian food per se now is probably among the top 4 or 5 most popular cuisines in the world. There's no reason why you can't have like a fast food outlet. There's no reason why Haldiram can't become a global brand.
So the business that I'm talking about, which could actually create big imagery for the country, is possibly anything which is a virtual business. Because virtual businesses have a habit of reaching out to people and touching people all across the globe simultaneously. And the virtual businesses we have today, anything to do with technology, tech products, tech services. Can you tomorrow claim that there is a part of India in you? There's a part of India, everything that you use every single day. Now, what can give you that? Every technology piece that you can take out.
Bijur also believes that a targeted investment from the central government will help small and medium businesses to build stronger and more global brands.
We have a total of 63 million SMEs in this country, but many of them don't know marketing, don't know branding, don't know advertising, don't know distribution, don't know how to reach out to the consumer. So if there can be an incentive for these types of enterprises, if you actually think of advertising, branding, marketing, sales, distribution, I think it can help.
Experts agree that Indian companies need to take an imaginative leap if they are to grow into global brands. However, they also point out that these firms should also work towards facilitating the global expansion of Brand India.
Cash holdings with mutual fund managers hit their highest level in nearly 10 months during February. This came as market sentiment remained sluggish amid higher interest rates and the global banking crisis. In our next report, Nikita Vasisht takes a look at factors that hint at a market rebound and where mutual fund managers could bottom fish.
Average cash holdings in equity mutual funds topped 6% in February, a level last seen in May 2021. According to a Motilal Oswal report, the average cash holding of top 20 mutual funds was 6.2% in February, with 4 mutual funds holding cash in excess of 10%. The move, fund managers said, was due to the global quagmire that has hurt equity markets so far in 2023. While the Adani Hindenburg saga hit domestic equities early this year, the pain got accentuated when Silicon Valley Bank, First Republic Bank and Signature Bank in the US and Credit Suisse in Europe sought bailout packages. For now, the crisis appears largely contained, but the underlying issue, that of high interest rates, is likely to hurt equities a little longer.
Summarize the equity environment, I would probably say that we are likely to face recessionary conditions globally before rebound. In this context, we expect the first 3 to 6 months of this calendar year to see the economic impact of interest rate increases that we saw in the last 6 to 9 months. So, given that is the case, I would expect the first half of this year to be turbulent from an economic standpoint, and hence probably economies bottom out in the second half of this year. And that's when maybe markets preempt a little bit, so maybe we can kind of look to deploy in and around that point in time. I can tell you the symptoms for market bottoming out would be peaking out of interest rates globally, bottoming out of global growth, which will be as a follow-on from that, and finally inflation easing.
Analysts at ICICI Securities, meanwhile, opine that quantitative tightening, at least in the US, may be in its last leg with smaller rate hikes ahead. According to their recent note, the recent bank failures have increased the prospects of quantitative easing later in the year on the fear of economy falling into a recession. As equity markets discount such events well before they actually play out, we expect valuation contraction to slow down from here on for sectors with better growth prospects. Given this, Bhattacharya of Edelweiss AMC cherry picks certain sectors.
And in that context, we actually find 5 themes where we think that the medium-term tailwinds are so strong that we can tide through, even through the recessionary conditions in flying colors. And these 5 themes are basically rebounding credit growth, and the beneficiaries of the same, improving private sector investment demand in the form of capex cycle plays, global market share gainers, and finally, country-specific themes like indigenization of defense and PLI beneficiaries.
Overall market volatility coupled with robust collections through the Systemic Investment Plan or SIP have ensured higher cash levels with mutual funds. But fund managers expect markets to tread sideways or even decline further in the next few months, allowing them to buy stocks at a better valuation. Today, markets will react to the US GDP data released overnight on Thursday and will track GDP data for the UK and India's infrastructure output data due to be released today.
Even as mutual fund managers wait to bottom fish, NPCI's move on interchange fee has left people worried. NPCI's decision to impose a 1.1% interchange fee on UPI wallet payments has led to a lot of speculation on social media. People are worried that this will make their transactions costlier. But is that true? Raghav Agarwal explains.
The National Payments Corporation of India recently announced that from April 1, a fee of up to 1.1% will have to be paid on payments between digital wallets and Unified Payments Interface apps. This fee will only apply to payments above Rs 2,000 made using prepaid payment instruments or PPIs, including gift cards. The PPI issuer will have to pay 15 basis points as wallet loading service charges to the account holder's bank. From next month, the users of UPI apps will be able to send money from their digital wallets to the merchant's bank account using a UPI QR code. Earlier, such transfers were possible only between the wallets of the same provider. For example, if you had money in your Paytm wallet, then earlier you could transfer it to another Paytm wallet but not to a PhonePe wallet. Now, these transactions have become interoperable. But such transactions will attract an interchange fee of 1.1% if the transaction amount is Rs 2,000 or more. This fee will be paid by the payment operator to the NPCI. This fee differs between sectors. It is 0.7% for telecom, education and utilities or post office sectors. For supermarkets, the fee is 0.9%. A fee of 1% will be levied for transactions related to insurance, government, mutual funds and railways. The fees for fuel and agriculture related transactions are 0.5% and 0.7% respectively. Payments from one UPI ID to another UPI ID will continue to be free like earlier. This money will be debited directly from your bank account and credited to the receiver's bank account like earlier without any fee. No, you will not have to pay an additional fee. Just after the NPCI circular was released, it issued a statement that the interoperable charges would only apply to merchant transactions. The payment will have to be done only by the payment operators. NPCI added that bank account-to-account payments make up around 99.9% of total UPI transactions, and these will remain free for customers and merchants.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Actually, UPI users need not worry as digital wallet payments will continue to be free for them. That's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.